Intro. Welcome back to the channel. Today we are going to talk about one of the most popular and widely used indicators in technical analysis, the RSI, which stands for Relative Strength Index. The RSI is one of those indicators that every trader and investor should know about because it gives you a very quick and clear picture of whether a stock is overbought or oversold. By the end of this video, you will understand exactly what RSI is, how it works, and how to use it practically. Let us get started. Section 1. What is RSI? The Relative Strength Index was developed by J. Wells Wilder in 1978 and introduced in his book New Concepts in Technical Trading Systems. It is a momentum oscillator, meaning it oscillates or moves back and forth between two extreme values. The RSI moves between 0 and 100. It measures the speed and magnitude of recent price changes to evaluate whether a stock is currently overvalued or undervalued by the market. The standard setting for RSI is 14 periods, meaning it looks at the last 14 days of price data to calculate its value. You will find the RSI displayed as a separate panel below the main price chart on any charting platform like TradingView or Zerodha-Kite. Section 2. Overbought and Oversold. The two most important levels on the RSI are 70 and 30. When the RSI rises above 70, the stock is considered overbought. This means the stock has been rising very rapidly and may have gone up too far too fast. It does not mean the stock will immediately fall, but it is a warning signal that the upward momentum may be getting exhausted and a pullback or correction could be coming. When the RSI falls below 30, the stock is considered oversold. This means the stock has been falling very rapidly and may have dropped too far too fast. Again, it does not mean the stock will immediately bounce, but it is a signal that the selling pressure may be getting exhausted and a recovery could be coming. Think of RSI above 70 as a yellow light. Be cautious about buying, and RSI below 30 as another yellow light. Be cautious about selling, or consider looking for buying opportunities. Section 3. RSI Divergence. Just like the MACD that we covered in our previous video, RSI divergence is one of the most powerful signals this indicator can generate. Bullish RSI divergence occurs when the price makes a lower low, but the RSI makes a higher low. This tells you that even though the price is still falling, the downward momentum is weakening and a reversal upward may be coming. Bearish RSI divergence occurs when the price makes a higher high, but the RSI makes a lower high. This tells you that even though the price is still rising, the upward momentum is weakening and a reversal downward may be coming. Divergence signals on RSI are considered very reliable because they give you an early warning before the price itself confirms the reversal, giving you time to prepare your trade. Section 4. Using RSI practically. Here are some practical ways to use RSI in your trading and investing. First, use RSI to avoid buying at the top. If you are interested in buying a stock but the RSI is already above 70, consider waiting for it to come back down before entering. This simple discipline can save you from buying at peaks. Second, use RSI to find buying opportunities. When a stock you like pulls back and the RSI drops below 30 or close to it, that could be a good time to consider buying, especially if there is a strong support level nearby. Third, never use RSI alone. Always combine it with other tools like support and resistance, moving averages, and candlestick patterns. An RSI below 30 at a strong support level with a bullish candlestick pattern is a much stronger signal than RSI alone. Fourth, remember that in a strong trending market, RSI can stay overbought or oversold for extended periods. A stock in a powerful uptrend can have RSI above 70 for weeks or even months. So always consider the broader trend before acting on RSI signals alone. Outro: to summarize, the RSI is a momentum oscillator that moves between 0 and 100. Above 70 signals overbought conditions and below 30 signals oversold conditions. RSI divergence, when price and RSI move in opposite directions, is one of the most reliable early warning signals of a potential reversal. And like all indicators, RSI works best when combined with other tools rather than used in isolation. The RSI is simple, visual, and incredibly useful. Add it to your chart today and start observing how it behaves with the stocks you follow. If you found this video helpful, please like and subscribe for more content on stock markets and economics. Thank you for watching, and I will see you in the next one.